The number one topic of the summer is the vast disconnect between the real-world economy on Main Street and the blistering rally in Wall Street stocks. My guest today is someone who sits at the crossroads of this discussion. I've asked him to come on today to tell us what's really happening with small and mid-sized businesses across the country, the current state of the consumer, and what we should expect as the children go back to school this fall and Main Street continues to reopen in defiance of the virus. Christopher Volk co-founded Store Capital in May 2011 and currently serves as the company's president and CEO. Store is a real estate investment trust, trades on the New York Stock Exchange. Just a little full disclosure, I have been a shareholder of Store for years, and this discussion is for informational purposes, not meant as an investment recommendation of any kind. Store Capital operates in the net lease space. They will buy a standalone building, often from a small business, unlocking capital for that small business to use for expansion or advertising or whatever. Store then becomes the landlord, but shifts the property taxes, the building insurance, and the maintenance over to the tenant who is responsible for making those payments. These three expenses are why this sort of arrangement is known as triple net lease. Store shareholders get a dividend distribution of these lease payments on a quarterly basis. Store's portfolio currently consists of just under 2,400 property locations and 456 business owners who are customers, and they're located in towns and cities all over America. Chris Volk, thank you for coming on the Compound Show. How did I do with my introduction?
Hey, Josh, you're brilliant. I was going to say, I think we own over 2,500 locations today. So
okay.
Outside of that, we're 554 as of Q2.
Okay. I thought I was going by your last quarterly report. So you sit at a really interesting space because your customers are essentially business owners who are operating in all different verticals, mostly serving consumers. There is some retail in there, but then there are a lot of other things. So do you want to talk a little bit about what your customers look like and where they are?
Sure. So we have today 504 customers, and they're in 49 states. We, as I said, own 2,554 locations. Our customers run 36,000 locations, so we own sort of a piece of what they do. Our customers in aggregate employ 2.5 million people, and they hired about 300,000 people in 2019. Their revenue increase in 2019 averaged around 12%. So these are vital businesses, and about 2/3 of what we do is centered in the service space. And service space will include everything from restaurants to fitness centers to early child education, veterinary clinics, and the like. Things that can't be bought over the internet. They're not hard goods; they're really services. And then the rest of our portfolio is really divided kind of evenly between retail, where you can buy a hard good. So names in the retail would include people like Bass Pro, Fleet Farm out of the Midwest. And then you have manufacturing, which is the other half of the remaining portfolio. So we are massively diversified. We're across really 110 plus industries, and we don't have more than 5% exposure to any industry except for 4 of them. And so we're hugely diversified in that respect. And then we're diversified by tenant because most of our tenants, I mean, the vast majority we have less than 1% exposure to. And our top 10 tenants are 17%, which is probably twice the exposure you get in amongst most of our peer companies.
Now, Chris, when the pandemic first hit, of all the companies in my portfolio that I thought about, I said to myself, Store is probably going to get hit the hardest, at least initially, just because so many businesses that are located in, on Main Street in towns and cities do require people leaving their homes, coming to visit. And, even if we're talking about someone getting their nails done or someone getting their hair cut or somebody visiting their personal trainer at his or her gym. So I said to myself, okay, Wall Street is gonna punish this stock, at least initially, which was fine because I understood why they would. Is that the way you saw it as the pandemic began to materialize? Was that your first instinct, is that people are going to overestimate the impact across our whole portfolio and just sell?
I think that's fair. I mean, I think people always think the worst, right? They plan for the worst and they're hoping for the best. And that's kind of an investor mentality in some respects. If you looked at our portfolio, the part that got hurt the most was exactly the service space.
Yeah.
And the service space is built to be resilient in the sense that it's not technologically dependent. So it's sectors that are designed to be around for a very long time. But in a pandemic where you're dealing with social gathering spots, the service space got hit the worst. And we had a lot of service space. So we had 65% exposure to service. So if you looked in the month of April, for example, we were collecting, call it 62% of our service rents. Meanwhile, the retail space, a lot better. In April, that was 82%. The manufacturing space, 92%.
Okay.
Today, we're kind of like 100% manufacturing is paying. We're at 95% of the retail is paying, so that's fine. It's the service space is coming up. Today we're kind of around 80% overall. And the aggregate we just announced this morning, and you probably saw the press release that we had collected 86% of our rents to date for August, and hopefully we'll have a small tick up through the rest of the month.
I did see that, and I was so happy to see that, and not just because of whatever my investments might be. I think that those numbers are just so important for overall confidence, and every time they tick up, even if it's just by a percentage point or two, like the way I picture it is, it's probably an extra 10,000 businesses being allowed to survive all over the country. So I like the fact that that's happening, and I hope it can continue. Simon Properties said in their last earnings report that they currently have something like 92% occupancy in their malls. And I know you don't operate in the mall space, but they say that that's roughly in line with their historical average. So what I want to ask you is, why do you think people think that the situation is so much worse than it really is? Do you think that there's this take on Main Street and retail and malls, et cetera, that because it's the highest profile tenants like Sears and JCPenney, who so visibly have gone under, that people just assume it's terrible across the board? Like, where does that opinion emanate from, if you had to guess?
Well, I think a lot of investors are centered in large urban areas. So you have folks centered in New York City or Boston or Chicago or San Francisco, to name just a few major urban areas where there are a lot of investors and money managers. And they see what's happening in those areas and how hard pressed it is. On the other hand, when you get out and you start looking around the country, and of course, STORE is spread across 49 states, and we're really spread across metropolitan statistical areas. They're outside of the top 25 MSAs. So, right. and in those areas, social distancing is more feasible. Complying with some of the rules that we have to in this COVID environment is much more feasible. And so the companies are able to be open and conduct business in ways where it's much harder to conduct business in major urban areas.
That's an interesting point. Like, a lot of the people that are investors or analysts writing about companies, or chief strategists that are writing about the economy for brokerage firms, they're in Boston, they're in New York City, they're in Chicago, and they have a take that maybe doesn't accord with what a company like yours is seeing. And you guys are not really concentrated in the top 10 metropolitan areas.
No, and what's happened with us is in March we had 77% of our locations open at the end of March. By the end of April, that had gone down to 65%. So that's kind of the worst of our portfolio. By May, it was 85%, June 91, July 92, August 93. Now, at some markets, we've seen some retraction. So, for example, or retrenchment. So, like Phoenix, Arizona, where the market that I live in, we've seen some retrenchment where health clubs and fitness clubs closed down, and we've had some exposure to that. But we've seen things opening up in other states. So overall, the portfolio has done fine. And what we're finding is that the rents that we're receiving are really tending to be a function of the prior month's opening. So if July had 92% open, then August is going to do that much better, and so on and so forth. So and the rents that we're getting have been in the last 2 months averaging 86%. So for July, we got 86%, but the June openings were 91%, August 86%, July openings 92%. So there's a small delta there. We're not getting 92% or 91% of the rents. And I think a part of that's because some of our tenants, like in the early childhood education space and even the fitness space, can't really fully open. So and still in the restaurant space, they can't fully open. So that's impairing their ability to pay us completely. But I expect that to go away as the COVID runs its course.
So I heard you on a conference call in the midst of the maelstrom, I guess, during the second quarter, and an analyst asked about whether or not you were seeing a lot of customers. I think he referred to them as tenants, but you guys call them customers. Whether or not you were seeing a lot of them come to you and look for forbearance or to rework a lease agreement or anything like that. And I think at the time you had mentioned that it really wasn't a large part of what you guys do. Like it wasn't a big number. I trust that's still the case.
Yeah, I mean, for the second quarter, we collected 73% of our rents in the aggregate, and so that means that we had to work out deferral agreements with 27% of our
Right.
And we did that. I mean, and of the tenants, of that 27%, we were able to negotiate and document transactions with 93% of those tenants. So we still have 7% outstanding. They're not quite finished yet. We'll get that done. If you compare that to other companies in our space, you'll find oftentimes that they still have yet to negotiate with 70 or 80% of their tenants. And a lot of this is because of the closeness we have with our tenants. You said we call them customers. They are like customers. I mean, we are a sort of a business partner with them. We are providing a real estate capital solution for them. They could own or rent their real estate. They're lucky to have a landlord instead of a banker. And so that relationship has allowed us to be able to work with our customers through this and to document these deferral arrangements. And we expect to get substantially paid back on most of the deferral arrangements that we've got.
Now, it's really smart to do that because it's not so easy to have a what you consider to be a high quality customer and then just replace them. It's not like a gym closes down in Corona summer and another gym comes and takes the space. So it's good business in addition to being the right thing to do, I guess, emotionally, spiritually. When you do a deferral, ultimately you expect to see that money back at some point. You're just not seeing it on time. And that's just, I guess, a better solution than losing the customer. You see it that way?
Totally. I mean, in a normal time period, let's say you're going through a recession or there's an economic reversal. Normally, we'll have some tenants that don't pay us. It's part of the business that we're in. We're just like being in a bank or something. So it's part of what we do. And sometimes, and very oftentimes, a tenant that's having issues is part of the solution. They're not part of the problem. So you're trying to figure out if a tenant's going to be there and they're part of the solution. In this case, it was a very easy choice. The coronavirus pandemic impacted a lot of our tenants through no fault of their own. They had perfectly good businesses. And in fact, their ability to cover our rent going into the pandemic was about 2 times over. So they could afford on a normal day to lose 30 to 40% of their sales and still pay us. But companies are not built to have no business. They're built to withstand some downturn, but they're not built to have no business. And that is what happened to a lot of companies as this pandemic unfolded.
Now, you had fortuitously raised some money, I think, in January or February. Not that you had the ability to see anything like this coming, but that came in handy when you were talking to investors and institutions who own your shares, right?
It did. I mean, sometimes you have opportunities. We had an opportunity to issue some stock a little bit early and get out ahead of our Q1 investment activity. So during Q1, we did over $300 million worth of investment activity, which was actually light for what we'd expected to do.
So, Chris, investment activity is you guys are always making changes in the portfolio of properties you have. So you might sell some things, you might buy.
Yeah.
Okay.
And we were buying real estate. So we were buying real estate locations in Q1. And during the course of a year, I mean, last year we invested about $1.2 billion net. We sold about $500 million of real estate. So it was 1.7 gross, sold 500. So we were at 1.2 billion net. So we expected to do a lot of activity this year. And on a normal quarter, we're going to do $300 to $400 million worth of transactions. We shut down our Q1 in March because of the COVID pandemic. Q2, we were shut down in April and most of May. And then sort of at the end of May and beginning of June, we had some opportunities. So we invested $135 million in Q2. At, by the way, a really interesting yield. So our yield for that $135 million was 8.7% in a 10-year treasury market where your treasuries are at 60 basis points.
Yes, I was going to ask you about that. you're in a position where you're able to buy real estate from people that can no longer hold it for one reason or the other. So is it fair to say that as difficult as this time period is and will be for the tenants, STORE has the ability to capitalize to some extent and take advantage of the environment that exists right now?
Well, the dynamic usually is that our tenants can hold it if they want to. So they could go to a bank.
No. People that you're buying properties from.
But this is true, right. So people that we're buying properties from, and we're usually typically buying properties from our tenants. So they're selling properties and renting them back. So our tenants oftentimes could keep owning them. They choose to rent them because it's just more efficient and they lowers their cost of capital.
Right.
What we found in the second quarter was that our tenants had been lining up acquisition opportunities. And a lot of our tenants are growing through acquisition. So they're veterinary clinics that are buying other veterinary clinic operators. They're early childhood education people. They're buying other early childhood education folks. So as we're seeing some of that happen, we found that our tenants were able to negotiate much better purchase prices in Q2. Sometimes transactions, Josh, just have to happen, for varying different reasons. And so our tenants were able to get great transactions, and then we too were able to get a nice return for our investors.
So if I had to ask in a sentence or two, what you see as the current environment for the small and mid-sized customers that you have, and by extension, the situation at large, like how would you describe the situation today versus the second quarter?
So we're focusing on mostly middle market. So our median tenant has about $50 million in revenue, which it sounds small in New York City, but when you're not on Wall Street, if you're on Main Street, right, $50 million in revenue is a lot of money. And our average dollar is going out to people that have well over 800 million in revenues. And I would say these customers / tenants have come to us, and they're by and large optimistic. Some of them have actually benefited from the COVID pandemic. So if you're selling camping gear, you look at a company like Camping World that practically hit an all-time high, or At Home, we have a few of those locations, and they hit an all-time high, 52-week high today. So some companies are doing well in this pandemic. Some companies less well, but they're seeing the end zone. And on top of that, the pandemic has given companies the chance to essentially re-engineer themselves in a way that they might not have done so otherwise. So I think that you'll see companies coming out of this pandemic operating with a higher level of efficiency than they did going into it.
Well, I hope that's the case. It's great to hear from you. I want to pivot to the fact that I think you're the only real estate investment trust in Berkshire Hathaway's portfolio, at least currently. So just to take a step back, Berkshire Hathaway invested initially in 2017. They bought $377 million worth of STORE capital, which worked out to 9.8% of your shares outstanding. They just put a 13F out last week, and they indicated that they'd grown their position in STORE by 31% during the quarter, which you told me makes you guys one of 3 or 4 public companies where they increased because they were selling things like JP Morgan, and I went and looked at some of the sales they had made. So it looks like they remain positive on you guys. I wanted to ask you, so despite the fact that you've done share offerings over the years, they're still about 9.5% of STORE capital, Berkshire Hathaway. So I wanted to ask you, just like personally, what does it feel like when the greatest investor of all time, Warren Buffett, makes an investment in your company? How much notice do you have before that gets filed publicly? Do you throw a party that night? Like, what is that feeling like?
All right, so I should give you some background. So
yeah, please.
In 2014, before we were even a public company, I sent Warren Buffett a cold email, just completely cold, to Berkshire@berkshire.com, and he responded to me in 3 hours. I had a thought of an idea of a transaction to do with him. And so then we started a dialogue, and he has a gentleman that works with him named Ted Wexler. So he's got a few investors, right, and you probably know Ted. So we started having extensive conversations, and ultimately they didn't do the transaction I had in mind. But what they did do is they followed our stock. And when Berkshire follows a stock, they follow it. They read every single transcript. They look at every single Q.
You came public in 2014?
Yeah, I came public in 2014.
Okay.
So in 2017, our stock hit a reverse in terms of where the share price was at the time, and Ted called up and said they'd like to buy 10% of the company. And so they ended up buying 9.8, but we actually issued primary stock. So we did a primary share issuance. I would say that, yeah, it was a very exciting moment to have an iconic investor like that buy your stock. There are a lot of investors, and you know this very well. I mean, there are a lot of really good value investors out there, and we have a number of them in our stock. But this particular company is just a household name, and they hold stocks for a long time in general. And when they buy companies, they buy them with the same thought process they would do if they were owning them. They think like an owner. And for those guys, they bought us because they really liked our business model and they liked the leadership team. And so we were gratified. And over the years, after 17, they kept the stock the same. And then when the stock got hurt in the COVID pandemic and Q2 especially, they started collecting more and more shares, and they built their position right back up to where it was. So it's as a percentage of the company.
And prior to coming public, I think you were seeded by Howard Marks. Did I read that somewhere?
Yeah, no, we were. That's right. Yeah, so Oak Tree Capital.
Okay, so I mean, you've had investors with outstanding pedigrees involved in your stock for years now. When you're thinking about shareholders, you know, a lot of people think about shareholders abstractly, but small business owners who are private, they know their shareholders. Like they're on first name basis with their shareholders. So you have a shareholder in Berkshire Hathaway that's, you know, kind of a legendary shareholder in the base. So I've always wanted to ask you, like, how does it feel knowing that when you report results, you're reporting results to Buffett, at least indirectly?
You know, I just feel terrific about it. First of all, you know, stores basically value investors. If you think about what we do, we're value investors through and through. Our lease yields tend to be higher than everybody else's. Our lease escalators tend to be higher than everybody else's. We manage our risk through diversity and by creating contract seniority. And so we're basically trying to make more money than the risk we take, which is always the goal of a value investor. And so to have the recognition of another value investor that's so well known and so iconic, it's been beyond gratifying. And I and the rest of the team were thrilled about it when they owned our stock. And we've had a chance to meet with Ted in person, and we talk to him frequently. So we talk to him at least once a quarter. And you know, they're the kind of investor you not just talk with, you learn things from. So it's just great to have shareholders like that.
I read somewhere that another corporation can't own more than 10% of a REIT's outstanding shares because it would trigger a change in how they do their own accounting. Is that accurate?
It's a tax issue. So if Berkshire Hathaway owns more than 10% of us, and they also own more than 10% of any of our tenants, then the rent income that we get from those tenants will be bad income from a REIT perspective. So it'll be just sort of like, you know, income that doesn't qualify for REIT purposes. And we have a basket for that. But, you know, a lot of times these companies like Berkshire are so big, they don't know exactly what they own, you know, so they could have a tenant and not be able to tell us, or an investment in a tenant not be able to tell us. So it's safer to stay under 10%, but it's not to say you can't do it. I mean, they could be at 20% or 25%.
Right, because conceivably they're now in used cars, they're in real estate brokerages. So that's how something like that could end up overlapping.
Yeah, I mean, we could own a Dairy Queen or whatever.
See's Candy or something.
Yeah,
okay.
Right.
Okay. I want to talk about the future of physical real estate and storefronts and mainstream commerce in general. I wanted to ask your take on how much will really change and then what will always stay the same in your view.
Well, to start with, I would say we feel pretty good about the relevancy of the portfolio that we've assembled. So as we get out of COVID, if you look today, about 3/4 of the deferral requests that we have from tenants are aligned with 5 service industries. Those 5 service industries would be fitness, theaters, education, family entertainment, and restaurants. I might have left out restaurants. That's basically 3/4 of the requests. We feel good about those sectors. We think they're going to come back. We don't think that there's going to be any issues about this stuff long term. We do think that there could be some shifts in how people behave. For example, on early childhood education, it's conceivable that if people are telecommuting more, the question will be, do they use early childhood education the same way? Do they leave their children off every single day? If people are telecommuting more, do they buy as many cars? Do they repair their cars as frequently? Is that going to affect new car sales? We have some car dealerships that we have. So the good news is that when we went into this pandemic, our median coverage is kind of 2 to 1. So you can lose 30 to 40% of our sales. When you own a company like Store, sometimes it's good to think like a debt investor. I mean, Howard Marks is a debt investor, and that's where you got to start, is distressed debt. And we're not an equity investor. We don't own the stock of At Home. We own a couple locations. So our claim is senior to the shareholders. So they can afford to lose some sales and still pay us the rent. And on average, our tenants can afford to lose 30 to 40% of sales and still pay us the rent. So to the extent that there's some adverse consequences that happen, we still expect to get paid the rent. But we'll keep our eye out on these industries. Meanwhile, there are industries we don't have that we're happy we don't have right now. We don't have any convenience stores, for example. There are a lot of reasons we don't have convenience stores. I mean, part of it is we don't like buying assets for more than replacement costs. We want to have unit level P&Ls. We want to have master leases. And so some of those chains that we can't get those. But also you get nervous about if people are driving less, there'll be less gas pumped in the country. If you're looking at alternative fuel vehicles, which is not a COVID issue, but if you're looking at alternative fuel vehicles, and there are lots of those on the horizon, that could change C-stores too.
Yeah, they're working toward 300 miles per charge is like the benchmark that they're all trying to get to. That's not great if you're a convenience store at a gas station.
No, and there's a car called Luma that's being made out of Phoenix that is going to be out allegedly in 2021 that it will have a 500-mile range. So it's a big deal.
All right, so you dodged a few bullets. No water parks in the portfolio.
No, we got a couple of them. I wish we did.
Oh, you do?
We have a couple of them, and we have we've got a ski hill. We have Durango Mountain Ski Resort, or it's called Purgatory in Colorado. We have another one in Colorado as well. And I think we feel pretty good about that stuff. The water parks have been hit this time around, but we think they'll come back.
Okay. The CEO of Walmart this morning, after reporting what can only be described as a blowout quarter, said the following, and I just want to get your reaction. He said, "My sense is that the order of tailwinds that impacted the business were 1, stimulus, 2, eating at home, 3, being at home, and all the things that you wanted to have the indoors and outdoors be more pleasurable." He's crushing Wall Street expectations in a moment where people still need to buy things and still need to get things in order to live their lives. They just might be spending money differently now and not traveling and doing things like that. But he put the stimulus first. So I wanted to ask you, as of this recording, we still don't have a deal between Congress and the White House on what they want to do to bring back the stimulus program that I think was really successful in the spring and summer. How important is that for your tenants, for the small and mid-sized businesses, and for Main Street, in your view?
Well, the stimulus came in a couple ways. First, you had the PPP money, and for some of our tenants, I think that helped them. Although if you were to look at some of the sectors I mentioned that were the problems, if you're looking at education or health clubs or movie theaters or family entertainment, they pretty much got no PPP money. So their ability to pay us has been just totally internally generated. The people who have been furloughed or laid off, of which there are millions and tens of millions, those people have benefited heavily from the stimulus. And I think that the lack of that stimulus as we keep this level of unemployment could be harmful to retail businesses. I mean, without question, it is going to lower discretionary income potentially substantially. And I think that people in the near term are nervous about that and hoping that Washington will get its act together. And
Chris, if you could wave a wand, what would you want them to focus on? If they could only pass some part of the proposed $1 trillion new stimulus bill, or like what would you tell them? This is the most effective thing that you've done. Do it again. Like, what would be your preference?
I think the expansion of unemployment benefits is the number one thing.
I would agree, probably for the most part, because it gets to the people who need it the most right now. And all of the other things are useful, but that seems to be the most acutely useful by families today. So I would agree. Well, I really appreciate your take on what's happening on Main Street and amongst the businesses that you guys serve. And I've told you this. I thought for a company that in many ways was in the epicenter of the pandemic this spring, I thought you've done a really good job keeping shareholders updated and communicating. So I want to say thank you for that. I think what I take away most from this is that I hope your sense that things will get back to normal, and we haven't seen such complete permanent change just because of the pandemic. I hope that ends up being the case. So I appreciate your insights on that. And I just want to thank you on behalf of the audience.
Well, Josh, it's a thrill. Thank you very much for having me.
Oh, it's my pleasure. And we'll talk soon, my friend. All right. Everyone, that's been Chris Volk. And you can learn more about Store Capital at their website. Are you storecapital.com?
Yes.
Okay. All right, Chris, thanks a lot.